So in the medium term, that's how, one can look at the markets. But in the very short run, and that is the period that we've seen in the past 3-4 months, and what has happened is that central banks around the world have pumped in liquidity like never before. It is unprecedented. The fiscal stimulus and the monetary stimulus globally is about 17 to 18% of global GDP. So that kind of adds up to maybe something like 12, 13 trillion dollars. And that is something that has never been seen, not in the 2008 financial crisis, or even very long ago in the depression of the 1930s. So this sort of liquidity has obviously come into markets, and that liquidity, obviously globally, it's not going into fixed income, it's not going into debt, because you hardly make money there. So people are saying, okay, if I'm making just 1% over there, why not I sort of look at equities? And the hurdle rate is not very high to beat that. So globally, money has gone into equities, it's gone into real assets, it's gone into gold and silver, as you've also seen that things have people have gone into those safe haven assets. It's probably going into commodities as well. So everything except fixed income, because rates are so low, people are investing into all those riskier assets, and therefore they have been inflated in the short run for no other reason, no fundamental reason, but a more technical or a more liquid reason. So this is really something that gives you some sort of a correlation as to why markets have gone up. And it's a more theoretical sort of a correlation. But I think I will stop here. I'll hand over to Naresh to kind of, talk more about investing. And, if there's time, then we'll come back to see about, what changes that we are seeing on the behavioral side in the stock markets. So over to you, Naresh.
Thank you, Mayank. Revered Father Xavier, my longtime friend Mayank, with whom I have enjoyed a relationship spanning over 25 years now, Mr. Khosla, and my fellow Xaverian friends. It's my honor and pleasure to be speaking to the alumni of my alma mater amidst nostalgic feelings. After such an excellent presentation by Father Xavier and Mayank, it will be a challenge for me to add further value, and still let me make an attempt to do so with slightly different approach. Investing is amongst the most boring things to do in life. It needs the discipline of simplicity, and that is what is quite boring about it, right? One can either create excitement or wealth. Both together is quite seldom. Certainly difficult in these challenging times, but let me make an attempt and briefly set the context. The pre-COVID backdrop is that in spite of all optimism, for whatever reason, returns from equity as a long-term wealth-creating asset class for a 5-year period from middle of 2014 to mid-2019 was in frustrating single digits. A ray of hope finally emerged when, in his Independence Day speech of 2019, the Prime Minister expressed that the country should be sensitive towards wealth creation of the nation. And this was followed by a slew of measures taken in general and corporate tax rate cut in particular. This change of gears by the government, signaling its willingness to take bold steps, built investor confidence. We could see some green shoots of an economic revival, and equity indices scaled a new peak in January of 2020. However, with the broader market just a shade above near-term lows, equity investors were not yet satisfied lot. On the fixed income side, post Ireland FS episode in 2018 to Yes Bank in 2020, a series of confidence-breaking downgrades and defaults adversely affected performance of a large section of debt funds meant for capital preservation and regular income. In this backdrop, COVID-19 came as a bolt from the blue, and nobody was prepared for, as nothing of this sort has been experienced by anyone living ever. Unprecedented and unthinkable measures taken to contain it created an unprecedented economic recession globally and in India. US economy has contracted one third in the second quarter. From 5%, India could contract to anywhere between -5 to -10% during the current fiscal, coming by various estimates. In fact, the RBI governor has not yet actually come out with their own estimates. The uncertainty is so heightened. And no wonder, not many could predict the speed and intensity of the resultant crash of the stock markets globally. Never ever has a bull market so decisively turned into a bear market in just over a fortnight of March 2020. This nerve-breaking fall eroded investor wealth and perhaps confidence worldwide. There were no takers for bonds either for a few days. Even gold, considered to be a safe haven asset class, fell due to liquidity pressures. And INR also fell. Subsequently, massive economic stimulus packages announced globally and some by India, where it rightly remains a work in progress, led to an apparent 25% relief rally in the stock market during April and May. However, since the lifting up of the national lockdown in June, it gathered steam and the relief rally appears to have become a full-fledged recovery rally, up 50% from March lows and just a shade below the peak. In fact, in the US, NASDAQ is at an all-time high. Interest rate cut, moratoriums, and other measures by RBI softened nerves in the fixed income market, leading to a bond rally. Gold has rallied to an all-time high. So what now? It's a health crisis converting into an economic crisis, a business crisis, and a financial markets crisis, hurting all individuals and most businesses like never before. So its solution lies in finding a solution to the health crisis, which is not yet in sight. With the prevailing uncertainty about the intensity, spread, and duration of this health crisis, it's difficult to predict the impact and duration on the economy, corporate performance, stock valuation, and the financial markets. It may get worse before it gets better, and when, we do not know. And the complicated uncertainty is something investors need to learn to live with and navigate cautiously. To my mind, this is a near-term new normal. As we wait for some clarity to emerge, it will be useful to keep the following in mind. Like always, human intellect will certainly find a solution to this health crisis. World powers and super brains across the globe are working on this, but we do not know when and how much damage it would have caused to the global economy and businesses by then. Meanwhile, economic activity has resumed, partly though, if not fully. Normalcy will take indefinite time. A new normal is most likely to emerge. Things will change in the way we live and work. Some businesses will benefit, some will suffer, some will die, and new ones will be born. Investors just need to stay away from trouble and explore the new opportunities. For an economic, business, and financial markets recovery, stage is getting set in the meanwhile. Inflation is down, interest rates are going down, oil prices crashed and likely to remain low, creating a sustained windfall for India. Economic stimulus and reforms by Government of India and RBI are a work in progress. Businesses are likely to consolidate towards larger and listed entities. Indian businesses may find attractive acquisition opportunities abroad, globally. And shaken by the recent experience with China as business globally try finding alternative supply chains and manufacturing hubs, India is likely to be a key beneficiary. Geopolitical issues created by China, particularly with India, is a point of concern and is making India trying to become Atmanirbhar. Government needs to play its cards well. So what are the behavioral changes of investors and the financial markets and what investors can do? Pre-COVID, we have been lately witnessing a slowdown in savings rate in India. A key reason is the consumption-driven, particularly younger millennial professionals who live by "Zindagi na milegi dobara" and "Kal kya hoga kisko pata, abhi zindagi ka le lo maza," that kind of a thought process. COVID-19 has provided a reality check, making realize the importance of savings and massive downswings in most businesses, professions, job cuts, and pay cuts. Temporary non-availability of several non-discretionary consumption avenues will not only induce savings, but will also make people realize that life can be enjoyed with less as well. Normally, head of a family behaves like a supercomputer, keeping everything about personal finance to himself or herself. The COVID-19 scare is making people realize the importance of making other family members aware about what is where and the like. This could be a major and useful behavioral change going forward. Generally, our advice to family businesses is to have a Chinese wall between business capital and family wealth. Time horizon for their requirements are not same, and so these need to be invested differently so that we do not land up compromising the needs of one for the other. However, the bankruptcy code and the COVID-19 have highlighted the problems of liquidity issues in business, turning into solvency issues from which family fortunes should be insulated. We feel this will bring a behavioral change amongst family businesses as well. There is a general lack of awareness and under-penetration of risk coverage through insurance in India, be it life or health. Nothing could have highlighted the importance of insurance better than a pandemic like COVID-19. Look at the popularity of COVID Kavach. Looking at insurance and more so as a risk cover will perhaps be an important behavioral change in society. As financial planners and wealth advisors, the first thing we make investors aware about is the importance of emergency funds, 3, 6, or 12 months of basic household expenditure. However, generally this gets ignored in a day-to-day life. COVID-19 disruptions and related uncertainties has highlighted the importance of emergency funds in households, and this could be a major behavioral change also. Liquidity and not returns should be the criteria for parking of such funds. Liquid or ultra short-term bond funds or in mutual funds are good options for this. Gold has no economic value. Still, it was always considered as the best hedge against all macroeconomic and geopolitical uncertainties and currency depreciation risk globally. No wonder gold forms a significant portion of reserves of most central banks in the developed world. Generally, it is advisable to have 5 to 10% gold in every portfolio, not as jewelry, which you will not generally sell, but as a financial asset. However, good times make most people ignore gold. During COVID-19, due to heightened uncertainties, it has reached new heights, both in rupee and dollar terms, and is widely expected to gain another 50% perhaps due to prevailing risks and uncertainties. So gold may now become an integral part of financial portfolios of investors. Sovereign gold bonds could be a good option for long-term investors with tax-free appreciation, if held till maturity, and the 2.5% interest rates as well. To store gold, to keep gold, you get paid 2.5% interest by the government of India. Most exotic structured products are better avoided. Investing is simple, mind you. Making it complicated is injurious to financial health, as many investors seeking excitement have witnessed. We feel heightened toxicity in most such products, which have been sold over the last few years and may give nasty surprises to investors going forward as well. Post lifting of the RBI mandated moratorium on loans, we are likely to witness heightened credit risk in fixed income markets once again. RBI has itself hinted at a minimum 50% rise in NPAs, if not more. Additionally, there are global risks in such circumstances for capital protection and income-seeking investors. Avoiding credit risk and long duration play could be useful. Bank and PSU bond funds, corporate bond funds, or short-term or ultra short-term bond funds with mostly AAA or sovereign are advisable. For long-term wealth creation, seeking investors, equities remain the best bet. And this is where things have become a bit more complex. Apart from the uncertainties discussed earlier, we have a situation where our economy is likely to shrink by 10 to 14% this year. And the recovery during next year is not expected to be anything significant. However, due to reasons already mentioned,